Okay, so yesterday we started to talk a little bit about mergers and acquisitions, and really more I kept talking about the gateway or the bridge between kind of standalone modeling and transactional modeling. And it all starts, in my mind, with a simple asset acquisition, because in a simple asset acquisition, you are raising funds to acquire something. And the idea of raising funds and debt versus equity is an important thing to start thinking about, right? The impacts of debt and equity raising on EPS. The idea behind acquiring things is an important thing to think about. And we start to talk about the modeling of it and how a simple asset acquisition can be done in a standalone operating model. So the question is, do you know that? And how do you walk through that? And that lends itself to plant a seed behind mergers and acquisitions, or corporate mergers and acquisitions, which we'll talk about, and also help satisfy a lot of potential investment banking questions that you might get. If anyone, did you end up receiving my workbook yet? Because it's just page after page of examples that you can kind of work on your own. Yeah, so it might be helpful for you guys. Or again, as I mentioned, it might be a little bit redundant for you guys in the class, because we're going to go through a lot of these things in class, but it's always more practice. So we started with looking at a simple asset acquisition and the accounting behind it. And a simple asset acquisition is done when acquiring an asset or a group of assets. Now, what is the process for that? What is the process for a simple asset acquisition? What do you think? What did we do yesterday?
Well, first, if you buy the assets.
Yep. You raise the debt or equity accordingly to account for the assets. Now, what happens if the asset was worth like $15 million, but we paid a little bit more for it than what it's worth? Or we paid a little bit less? What happens to that?
On that time, you make the gain or loss.
Do you?
No.
No, because
you answered the question and then you said no.
You buy, you're not selling.
Because probably the way I said D. What difference does it make?
You say by asset or by a company?
Asset.
Asset.
Yeah.
So probably is now, if you pay more, it will not be a goodwill or real debt.
Well, if you lost the money on that the next year on tax.
Well, you're buying. Why did you lose the money?
Yeah, you don't.
Because you pay more.
Because you pay more? So it's a value loss?
Yes.
Is it a value loss?
No.
If you don't sell it, no.
Why not? No, if you buy it.
But accounting is supposed to be.
No, yeah, because you buy, so
it's an interesting, good
the value, no, it's not necessarily the money you pay equal to the value. You know, or maybe it's like.
But that's what I'm saying. It's not equal to value because you pay more than that.
So how do you say I pay more? Say what?
So what do you do with that difference? Yeah.
The difference is reflect your tax because you.
Nope.
No.
It's reflected in taxes? What do you mean?
If you lost money on something and that's reduce your income.
That's if you're selling.
Yeah.
Because there's no recorded loss if you're buying, right? If you're buying, what's the loss?
So you mean overpaid?
Let's say, well, you overpaid. But who's to say you overpaid?
You say you paid it like you said that, right?
Yeah, but no, I asked you that. But what defines overpaid?
Yeah, he wants my question. So how do you know the real, how much I should pay right now?
Why is that a question? This is the question accountants ask. Because valuation is subjective. No, I just answered the question. Because valuation is subjective.
What?
Valuation is subjective.
Yeah. So.
But what do I mean by that? So in a fair market environment, the base theory is the price paid for an asset reflects its new valuation. I don't care what the asset was worth. It means nothing to me. If I paid $20,000 for it, it's worth $20,000 to me.
Okay.
So generally, there are some exceptions, but generally, the rules start with, we talked about this way back with depreciation when you buy a car, and when the price paid for the asset becomes its new book value. So if there's an asset worth $15,000, I paid $20,000 for it, it's up on my PP&E at $20,000. There's no need to record that differential. There's no concept of winning or losing money on it because If you believe that, if you're paid for that, then the idea is, well, you believe that's its value. Otherwise, you wouldn't have paid for it. That's the idea. Now,
When you sell it, you have to just.
yes, but I didn't have to talk about that. I was talking about buying.
So there's no overpay, so whatever you pay becomes book value.
Right. Right. You are stepping up the assets to your value. Right? What's that? You just set the price of the market. In other words, if I paid stock price $100, I paid $100 for the stock price. If a bunch of investors are paying $101, the stock price goes up. You're not losing money because you paid more for it. Yeah, maybe you'll lose money if you paid for that and the stock price ends up going down later, but that's a different concept. That's a different dynamic. Investors set the market. We're investing in this business, we're setting the market. Now, there is a concept of goodwill where the difference between price paid and the book value of an entity gets recorded differently. We'll talk about that when we talk about corporate entities. We'll talk about goodwill. In some situations, if you pay more for an asset than what it's worth, there's this goodwill concept. We'll get to that. For now, it is core. If I paid $20,000 for it, no matter what it was worth before, it's now worth $20,000. Goes up on my PP&E $20,000. The seller has to be concerned about that difference, but we as the buyer don't. So in this example, we gave, let's say that John pays $20,000 for a new truck. He pays $10,000 in equity and borrows $10,000 in debt, right? Equity raised, debt raised. Okay, $10,000. So he ends with the truck $20,000. He ends with debt of $10,000, and he ends with equity of $10,000. So his liabilities increase, his equity increases, and his PP&E increases. Okay, now let's take a deeper example. What if we were to acquire a $125 million asset? I want to do this so I have this recorded, okay? What is the impact of the income statement on the income statement, cash flow, and balance sheet of an acquisition that's $125 million, so $125 million asset acquisition, okay? Let's say $25 million in equity, $100 million in debt, 10 years useful life, 40% tax, 10% interest. What is the impact on the income statement, cash flow statement, balance sheet? Now, I know you said you're pretty comfortable with this, but let's just do it one more time just for the sake of recording it. Yesterday, the recording was broken up. Let's go through this. Maybe I'll take just 5 minutes. If you guys are really comfortable with it, then we'll just kind of go through it. But I think it's important to have one version of this documented, okay? So remember, I do not recommend to do all the income statement flows, then all the cash flow statement flows, then all the balance sheet flows, right? Break this up into several transactions. First, you have to raise the equity. Then you have to raise the debt, right? What's the income statement, cash flow statement, balance sheet impact of raising the debt? And there's interest on the debt. What's the impact of the 10% interest on the income statement, cash flow statement, balance sheet? Then you purchase the asset, and all of a sudden you realize the movements of the asset's purchase is pretty simple, right? Just cash down, asset up. Then there's depreciation on the asset. What's the impact of depreciation on the income statement, cash flow, balance sheet? Then there's the potential of accelerating depreciation. What's the potential of accelerating depreciation on the income statement, cash statement, balance sheet? And if you can go through all these movements efficiently, this handles a lot of potential investment banking interview questions around income statement, cash flow statement, balance sheet flows. Nobody will probably ask you all this in one shot, but they could ask pieces of this. If I were to raise debt, what's the impact? What's the impact of interest? What's the impact of an asset acquisition? What's the impact of depreciation on an asset? And don't forget about accelerating. I've seen these questions asked, but separately. So going through this yourself is a great test of all those flows questions. So take a few minutes. Let's see how fast you can do it, and then we'll go through it together. I want to start kind of going through this. So if you have $25 million in equity, real simple. You guys know what the movements are? Oops. We're going to get $25 million in equity here.
Say 125.
Nope, 25. 25 equity. Make that blue. Okay. Bring this down a little bit. Whoops. And then cash is 25 million. So let me just make the format here consistent. So equity 25 million, cash 25 million, and then what happens to the balance sheet? Cash 25 million. I'll put pluses here. Cash 25 million. Right? And then equity 25 million down here. Okay? Now what? What else happens when you raise equity? We got, whoops, we got shares and dividends, and increase in shares and dividends. Yeah, let's just leave it open. That's fine. It's not going to really, we're not going to go down and calculate EPS, but that's fine. Okay, what about debt? So we're going to increase debt by 100 million. So that's it for the cash. Debt is 100 million. I'll make debt red. Okay. And then what? Impacts cash. Okay. And what else happens? Cash here and debt. Real simple. Cash up, debt up, cash up, equity up. Okay? What else happens with debt? Interest. 10%. We have interest expense of 10 million. Right? And then what happens? Has a benefit impact on our taxes of 40%. So I'm going to show interest as a negative because it's an expense. Tax savings 4. Right? So the net income impact is above shares 6. Okay? Now what happens? Net income always drives cash flow. And cash 6 million. And this is down, not up, all the way around, right? Cash is down because of the expense and net down. Whoops. Okay. And how does it balance? Retain earnings. Net income. Okay? We've raised the debt, we've raised the equity. That's how it works. Real simple. That's how you do a debt raise, that's how you do an equity raise. How do we do it in the model? We spoke yesterday how we do this in the model. How do we raise equity in the model? Nope. That's, I am making things up. How do you raise equity? You don't raise equity on the debt schedule, right? You could make an equity schedule if you wanted to, but not as common as the debt schedule. Where else? Okay, well we can start there. And if you know on this balance sheet, where does this come from? Where does this drive from? Cash flow. And here, where does this drive from? It's a hard code. Good. That's the way you want to do it. Good. You just pick a place and trace it back. What about the debt?
Start from the debt schedule.
Debt schedule.
To cash flow.
Right. Debt schedule would link into here and into here. So if you were to go in your model and increase that equity line item, that hard code from 0 to 25 million, and then debt, like long-term debt to 100 million, you'd raise the debt. It would flow through all these movements. It would link into interest expense, make all these flows if you have a properly built operating model. Okay, what about now the acquisition of the asset?
Acquisition of an asset.
Mm-hmm.
CapEx.
Okay, how much?
125.
Goes down.
Yes. Negative 125.
CapEx down 125 million to reflect the asset purchase. What else? Cash goes down, so that cash we raised is spent. What else? Cash goes down. And then what happens? It goes up. 125 million. So really the act of the acquisition is really simple once you have all the pieces in place. CapEx, say it again?
Cash.
Oh, I see. Yeah. Thank you. Cash down, asset up.
Same thing in the last slide.
Cash down, asset up. Thank you. That's the way I copied it. Real simple. Cash down, asset up. But nothing. Except the idea that this over a period, this CapEx will cause depreciation. And it might even potentially cause accelerated depreciation if we accelerate the depreciation on our assets for deferred tax purposes. So let's do that. And I gave you the assumption that the depreciation was 10 years. So 10 years on 125 million is 12.5, right? 12.5. So what happens for depreciation?
First of all, let's take the depreciation and expense.
12.5 million, right? Tax impact on that? 5. So that's 5. And tax goes up 5 million. And so the net income impact on that is 7.5 million. Okay? Just an added expense gets trickled down. What happens with that expense? Now what happens? Cash flow. Net income drives cash flow. Okay.
Depreciation goes up.
Okay. Depreciation is a non-cash expense. It is always an add back. So we got to add back that 12.5. So this net income and depreciation impacts our cash again 7.5 million. Right? I'm sorry, 5 million. And this should make sense. This reflects our tax savings on the expense. Okay, now each of these line items, the ones in black, must drive, every line item must drive the balance sheet. We've already handled everything except the impact on depreciation. So what happens to net income that we just added? Retained earnings. What happened to D&A that we just added? PP&E goes down. It's a reduction in PP&E. What happens to, what else do we move? The cash. Where does that go? Up 5. So we've handled everything. Okay? That's the impact on the acquisition and depreciation of the asset. But we're not done, right? What if we decide to accelerate depreciation on that asset for deferred tax purposes using the double declining balance method? What do we do?
Now, the deferred tax will be what?
You have to first do the deferred tax, the double decline.
So accelerated depreciation is 1 divided by useful life
Useful life times 2.
times 2, which is 20%, times 2 is 20%. 20%, right? That's the double declining balance rate, and then you apply 20% times the size of the asset, okay, which should give you 25 million, okay? So that's the accelerated depreciation. Now, the formula for using accelerated depreciation to create a deferred tax liability is what? Is accelerated depreciation minus the straight line, okay, times the tax rate, equals 12.5 million times 40%, it's 5 million. So the accelerated depreciation minus the straight line times tax rate gives us the deferred taxes. What do we do with those deferred taxes? Add back in the cash flow. So that becomes an add back. So after depreciation, we have in our cash from operations deferred tax line item of 5 million. This is a different color. Okay. And that impacts cash by 5 million. Okay. And that cash goes up. And what's the balancing impact?
Debt goes up.
Not debt.
Debt is deferred tax.
Deferred tax. It's a liability. Okay. That's it. That's everything. These are all the movements, all the major movements in a simple asset acquisition. So again, great to cover and test your knowledge of a lot of the major flows. Now, how do we do all this in the model? So we talked about raising debt, covering all the red. We talked about raising equity, causing all the blue. How do we handle all the black and yellow line items in the model? How do we facilitate the asset acquisition, the impact of debt, and the impact of accelerating debt? How do we do that in our Walmart model?
You increase the capex.
Increase the capex. And then what?
So from there, it should be automatic.
All flows, right? If your model is built properly, you increase capex, and this drives your depreciation schedule. If you increase capex, this will flow into your PP&E and your balance sheet. Capex also drives your depreciation schedule. It also drives your accelerated depreciation schedule. So all of this is handled by just increasing capex. So that's the test. Can you walk yourself through that? Any questions? Okay. So that's a simple asset acquisition. Now in this original example, we took the case of what happens if we were to buy an asset. The asset's worth $20,000. We now own this asset, $20,000, right? Not forget the one note example. This example on the slides. Now let's say what happens. This is what we just did in more detail. What happens when we want to divest the asset? Okay. When divesting an asset, unlike acquiring an asset, we talked about the step up of assets, right? When divesting an asset, you do have to be concerned about the monies received and whether it's greater than or less than the value of the asset. Why are you concerned now? Who can explain that? Why now you're concerned and before you weren't? Nope, goodwill isn't an acquisition, but there's no goodwill yet. Goodwill isn't in a divestiture. Why else? Ray, what do you think? Based on what we just discussed. Or Dal, what do you think? You kind of started to say it before.
Can you phrase the question again? Sorry.
When you're divesting an asset, why are we now concerned about the property value?
We lost the money.
Yes. Why were you not concerned in the acquisition? You're correct.
We're doing the acquisition, you think that's the right price, so I don't pay it.
Yeah. Meaning what? When you divest it, what happens?
Because you have your historical costs.
Yes.
So you have to, if you sell more than your historical costs or the book value, book value, so you will recognize loss.
Right.
I guess.
Yes.
Got it.
You have to. Yeah, if you're acquiring it, it was never on your balance sheet. Who cares? More or less. You pay $50,000 for it, it's $50,000. When you divest it, it's a concern, right? If you have an asset, let's say the only thing you have is this one truck, it's $20,000. If somebody gives you $25,000 for it, you can't remove $25,000 from your PP&E. You'd have negative PP&E. You have to be more accurate about the difference between the price paid and the actual asset value. We spoke about all morning about when an acquisition, you don't care. It doesn't matter the way the accounting works. But in the divestiture, it's a concern. The accounting, it gets more complicated when you divest it because otherwise you'd have a balance that's inaccurate. So the difference between the value on your books, who cares about market value? The value on your books and the monies received, that difference becomes a gain or loss on sale. And we have to account for that accordingly. Yeah? So that gain or loss on sale is a net income item, is an income statement item, or comprehensive income statement item. So let's...
Separate question now, sorry.
Yeah.
It may not be directly related, but yesterday we were asked the question, like when we have a PP, an acquired asset that's a construction, how do we go about recording in the books while it's being constructed and once it's done? So let's say we're making a factory for $150 million, and then while it's being constructed, how do you record it in your books versus when it's completed? So something along the lines where Clete said that DNA, you don't start accumulating DNA until the project is finished, and until the project is being built in construction, you have accounts payable that gets recorded.
Let's continue with this,
Okay.
and then we'll get back to that. Let me just, I'm on a good flow here, and then we'll talk about your model in a second. Yeah. We'll come back to that in a second. There'll be a point where we have a good pause, and then we'll cover that. Just I don't want to lose sight of our conversation here on the divestiture. So so in this example, in the divestiture, we record the gain or loss on sale. And let's take the example of the acquisition, right, the truck that we acquired. Now let's say that in this situation, the truck that we acquired 7 years later, we're interested in divesting it, okay? 7 years later, the truck's depreciated over time. The truck's depreciated now, and it's depreciated down to $13,000. Okay, it's depreciated down to $13,000. Somebody puts out an offer. We want to sell it. Somebody offers us $15,000 for it. Okay, so we have a truck that's worth $13,000. Somebody gives us $15,000 for it. What happens to that difference? How does the accounting work? Do you have any ideas how the accounting works? Is it a loss or a gain, first of all? Good question. Is that a loss?
You should add the depreciation while you pay for that.
Well, is this a loss or a gain, first of all?
It's loss.
It's a loss? You're receiving $15,000 for the asset that's worth $13,000. It's a gain. It's okay. It's a gain. So how do we record this? It could be other income. It could be a non-occurring event. let me step through this, okay? So in this example, we have here before the sale and after the sale, right? Left column, right column. We have an income statement, we have a cash flow statement, we have a balance sheet. I like to start by looking at the balance sheet. Before the sale, we had, let's assume very simple, just this truck is all we had. No cash, we had the truck, we had equity that we raised to pay for the truck. Actually, in the prior example, we had raised debt, but let's say we paid down the debt with equity. So everything's been depreciated down, $13,000. How's the equity? It's a side question that does pertain to this. If we had raised $20 million to pay for this truck and the truck's depreciated down to $13 million, how come the equity is reduced as well? How does that stay in balance? How come the equity is reduced down?
Just because assets goes down due to depreciation, so will affect your return earnings.
That's right. It's retained earnings. The retained earnings has reduced that. The retained earnings, in this case, there's nothing else going on. The retained earnings was, and assuming no tax savings on that, the average depreciation hit each year, hits negative net income, flows into retained earnings, and that's right. That's exactly what happens. So let's say it's okay. At the end, we have a balancing balance sheet, just the truck and equity. That's all we have here before the sale. Net income, let's say we generated revenue, but we have so much costs that our net income was effectively zero, just to keep this example simple. And on the cash flow, net income is zero, and there's no other cash flow adjustments to that. Very simple. What happens after the sale? To illustrate how a divestiture works, after the sale, we've collected $15 million, right? Our truck has went away. Our truck has gone to zero, okay? And our shareholders' equity, in order for it to balance, must go up from 13 to 15. So a couple things. How does all that work? How does our cash and our cash flow statement show 15? How does our truck reduce to zero from 13? Not all the way down to negative 2, right? If we had removed 15 million from the PP&E, we would have a negative balance. That's why you can only remove the PP&E, just the asset value, not the monies received. Remember, we received 15,000 from it. How does equity go up by 2? Well, knowing that equity is driven from equity raising, shareholders' equity, investing, there's no other investment here, and retained earnings, let's look at the net income. So in the net income, we have before the sale, after the sale, everything's the same. We recorded the gain on sale. Here we recorded it as an extraordinary item. Gain on sale of truck. Forget taxes in this example. Gain on sale of truck of $2 million. That's the gain. That's the 15 minus the 2. It's the monies received above and beyond, above what the actual value was. We recorded a gain. Okay? That's how that drives shareholders' equity. That's how shareholders' equity is increased from 13 to 15. Okay? Now, what about cash? Cash gets a little tricky because that 2 drives the cash flow statement. Right? Now, one other thing we have to do is we have to record in our investing activities the monies received from the sale of the truck. The monies received. If we've sold the truck for 15 million or 15,000, we have to record 15,000. So now what happens is, if we recorded 15,000 for sale of the truck, and if we have an additional 2 from net income, that's actually 17. That's too much money. We didn't have 17. We had 15. So we have to make an adjustment in our cash flow statement. We make an adjustment in our cash flow from operations to remove the gain on sale. Now, theoretically, conceptually, and from an accounting perspective, that removal is happening for 2 reasons. One, we don't want to, without that removal, we'd be double counting the gain because we're showing 15 million in the investing activities, and we already have 2 million from the gain from the income statement. So we want to remove it from there. Second, too, is that gain on sale is extraordinary, and we want to strip out extraordinary items from our cash from operations. So we move it out for 2 reasons. We're basically moving that 2 and representing it better in the sale of truck. Okay, now this also completes a really important cash flow, drives the balance sheet movement that a lot of people are confused about. If you look at, remember how every cash flow statement line item must drive the balance sheet, right? Net income here is driving retained earnings. That's how our net income or retained earnings goes up by 2, or our shareholders' equity. The total cash flow is driving cash, 15 million, right? What about PP&E? How do we have the PP&E go down by 13 million? This confuses a lot of people. This is another another reason why I strongly recommend always having your cash flow statement drive the balance sheet. Otherwise, this confuses a lot of people. As divestitures, I remember at Morgan Stanley would throw people off. It doesn't if you keep with this logic. That 13 million is very simply a net of the sale of truck and the gain on sale. 15 minus 2 is 13. So if you have the 15 minus the 2 feed into your PP&E, it will reduce it by 13 million. And you're satisfying every cash flow statement driving the balance sheet. It just works in all different ways. And this also answers a big confusing question I get from analysts is, why is the removal of gain on sale drive the asset? Now you know why. Because it's offsetting the monies received from the sale of truck. The sale of truck does not directly affect the asset. If you pull that directly into the asset, you'd be overstating. I get a negative PP&E. It's the sale of the truck after the gain gets us from the monies received to the sale to the actual PP&E value of the sale. That's the confusing point about divestitures. Sticking with the logic of cash flow drives the balance sheet helps think through these types of things. Okay? Let's try one. Let's say I have now divested this $125 million asset. Okay, I divested it. I received $150 million for it. What's the impact on the income statement, cash flow, and balance sheet?
What's the book value?
125 million.
120. So it's 150.
Mm-hmm. What is the impact? Forget taxes. What is the impact?
So
think about it.
Start with income statement.
Think about it. Yeah, think it through. Draw it through.
Out loud or just?
Okay, what do you guys think? Let's together step through it. So this, when you sell $125 million asset, sold for $150 million, it is a gain. Sure, right? You receive more money than what it's worth, right? So what happens then?
Gain on sales.
Where?
Under the net income.
Income statement.
Yes.
Okay, so we have gain on asset sale of 25 million.
Below the net income or?
Unless
Yeah, it's below net income, right?
below the net income. Yes.
But
Yeah, there's we'll have net income that goes up 25 million, right?
It was extraordinary and one-off non-recurring item. Wouldn't it be below net income?
There's net income after non-occurring items. Yeah, even on Walmart models, we have net income after non-occurring items. Yeah, the Walmart model had net income after non-occurring items, and then it adjusted out its non-occurring items, right? Yeah.
Cash flow. Net income.
Cash flow, net income 25.
And under it is minus 25 gain on sale.
So we're going to remove the gain. It's an adjustment for the gain. We'll remove that back out. Okay.
And then what's like the qualitative reasoning? How do you explain why we do this?
Remove it out?
I get it, but like how do you explain why you remove it?
Because it's not part of.
Just discussed it.
operation.
Same reason. It's not part of operation.
You mean same reason that we just discussed it here? Same reason as this? Yeah. And what else? Yeah.
Double count.
Yeah, that's right. And it double counts.
Yes. The PP&E will make that original now.
Correct.
PP&E
Exactly.
is 25.
And
Exactly.
the sales of the asset is one.
So sale of asset is 150. Right? Without that, we'd be removing 150. Too much. We move 150 from PP&E, too much. So what's the net cash impact? We get 150 cash, that's true, we get the cash. Okay? Now all this must drive the balance sheet. Right? So cash impacts cash. What else?
Assets, sales, PPE.
Asset was worth 125, so we gotta remove that from the book.
Remove what?
125 million PP&E.
So what really happens in the model is you want both of these new line items that you've added to drive PP&E. Sale of asset goes into PP&E. Gain on asset sale goes into PP&E. So it's a net 125 that goes into PP&E. So the PP&E is minus 125. Okay? And finally, retained earnings is up by 25 million.
Yeah, not bad.
That was good. Yeah. Yeah. That's good. Okay. Let's do one with a loss this time. Let's say you have a $75 million asset. What do you think? So we have, let's say in this case, we have a $75 million asset sold for $70 million. Okay. What do you guys think? Counts for a loss. 5 million. Which is reflected in the net income. And then what? Drives net income. Then what?
Loss plus 1. That's loss.
Plus 5.
Yeah, sorry, plus 5. That's 25.
The loss adjustment, you're adjusting out the negative, up by 5, zeroes out cash from operations. What's the sale? 70. The money is received. So we only got 70 for the $75 million asset. So cash becomes 70, and this is where the PP&E now, even though it's only 70 received, we want to pull out 75 from the asset. Right, so the asset's going to go down 75, and it balances because the retained earnings actually shows a loss of 5. Okay? Okay. Now, let's take this a step further. What? Taxes. Right. Your tax on gains. So let's say we have an example of an asset that we sold for $200 million. It's worth $150 million. So we got a big gain. Yeah. And we're taxed at 40%. Sometimes taxes are really high on capital gains, but let's say we're taxed 40% on that. Think through what happens now with the implication of taxes. So let's say we have a $150 million asset sold for $200 million, gain taxed at 40%. So think about that, and we'll go through it together. Okay, so what do you think happens?
Gain on sale first of all, right? We
have a gain on sale. How much? Okay, then what?
Taxes.
Taxes?
20.
20.
And so net income goes up by 30.
Yeah, so I actually do, what we usually do is, as you know, you record the net, you record the non-recurring event on an after-tax basis. It's already tax effective. Right? You bring it down above the tax line. It's an after-tax number. So we'll do after-tax gain on sale. You don't have tax lines down there, right? I don't think you've ever seen tax lines underneath taxes. You only have one tax line. So if there's anything that's recorded underneath taxes, it's always net of taxes. So we'll do the after-tax gain of sale, which is 30 million, and that's, oops, that's the 50 million times 1 minus 40%, right? which means the net income is already down 30 million. Okay.
No.
Oh, these are gains, yes. Okay. So now what?
Net income on cash flow goes up by 30.
Yep.
We gotta adjust it.
Yep.
I believe the adjustment you make is pre-tax 50.
Yeah. Adjustment is in full. So the adjustment, you make an adjustment, and that's the kind of tricky part for gain on sale, which is you're netting out the full amount. It's all non-cash, right? Or however you think about it.
Yes. But then you create a liability to pay the taxes of 20 million.
So, well, let's see what happens now. Okay? So now what happens?
You have to pay it.
It's not a liability. What's the next line item?
So,
Sale of truck. Sale of asset. We received
cash from 250,
200 million.
other residual.
Okay? Sale of asset, 200 million. And that ends up netting in the cash. Okay. It's all going crazy now. The cash impact is now 180, right? So this should make sense if you think about kind of the logic is you receive 200 million. Who cares about the asset value? You receive 200 million. You got to pay 20 million in taxes on it. You have to. You have to take the capital gains. So the capital gains tax is on the gain, on the 50 million. So that's 180 million net. Okay? Now how does all this impact the balance sheet?
180 goes to
Cash 180. So now PP&E is impacted by the net 200 minus 50, by the 150 of course, because that's the actual value that's being removed. Right? Retained earnings. The retained earnings impact is not the full 50, it's the 30. Whereas that, without taxes, we get a little bit more cash, we get a little more retained earnings. But no, this is tax affected. So cash went out by 20, retained earnings went down by 20. That's how it works.
So we're assuming that the taxes are already paid, so we don't pay a liability. Is that what it is, man? So I think I would completely.
No. Why would you assume that?
To pay taxes is 20 million.
Why would the government let you do that? They wouldn't do that. Yeah, pay us cash. You got the cash. Unless you want to do accelerated depreciation and this and that, but then you're selling it, yeah. Okay. That's all I'm going to talk about divestitures. It rarely comes up in interviews, divestitures, gains on sales. It rarely comes up. It's just a good side tidbit to know because we get a lot of questions on that when talking about asset acquisitions. So it just happened to kind of be a natural, even Alex asked about it yesterday, but you asked about acquisitions, people are curious about divestitures, and there's a lot of things in there it's important to know. So you have it in the recordings. I don't even think I talk about it in the book. I talk about it a little bit in the book, but that's it. Anything M&A is usually an acquisition or a merger. So let's get to Drew's question. About the timing.
If you are acquiring a building, or if you're actually constructing a building instead of acquiring, so you're making the building, how do you record it in the books while it's being constructed and once it's finished?
So you usually, CapEx is recorded when the money's been spent.
CapEx is recorded when the money is being spent.
And depreciation, I see your point, usually doesn't happen on day one. Now, if you go to our maker schedule, remember there are 4 types of maker schedules. Asset comes in line half the year, asset comes in line in the middle of the first quarter, middle of the second quarter, middle of the third quarter. Usually the timing is handled for then. So if you know when the asset is coming online, you would obviously not start depreciating until that happens. So comes online. So Whoever is building the project has to give you assumptions on that. So if you know the house is not going to come online until 6 months out, if you're doing straight line depreciation, in that first year, whatever you do, asset divided by 10 times 50%.
While asset is being built. Or you don't even start.
Well,
Or straight line.
this is the assumption that the asset will be built and start depreciating halfway through, 6 months in.
But that's for makers, right?
Nope, that was straight line.
That is for straight line.
Divided by 10, that's straight line. For makers, you would use the then half-year makers formula.
Got it.
You do not start depreciation while the asset is being built. You do not start depreciation until it's complete.
You don't depreciate the capital?
But it's,
You will ultimately depreciate the capex.
yeah, but you overstate your depreciation if asset is being built and you're depreciating, right? Because
So you can make a timing adjustment for that,
give me a time.
just as I discussed. Yeah. Now, usually what happens is, and you see in the model, we assume that the money's been spent January 1st, and that the capex will begin somewhere within the first quarter, so there's really no adjustment to make. If you really want to get into adjustments within a quarter, then you should be building a monthly model, you know. But other than that, you would just make that haircut adjustment to the depreciation. All right, so I want to now further this discussion, and we've been talking about acquiring assets, divesting assets, and I'll do, if you look at chapter 1 of the book, there's like an overview of all the types of M&A activity that's out there. We'll get into that when we really transition into kind of the full-scale modeling. I just think it flows better there. But remember, what we've been talking about is acquiring an asset. What happens if you get into corporate acquisitions, acquiring an entity, when there's a lot more moving parts than just the assets? That's the complexity of this accretion dilution analysis and modeling out all the line items and the things that you probably are a little bit more aware of when thinking about mergers and acquisitions. However, it's important to note when acquiring an entity, when thinking about a business, more than just a little piece of property, there are several ways to consider accounting for that acquisition. You can treat the acquisition of an entity as an acquisition of just the assets of that entity, or an acquisition of the entire equity. And that makes certain differences. This is something you have to elect for and negotiate. So in other words, I like to give the example of, let's say, a power company. Anyone dealing with energy in your internships? Energy, like power? Somebody asked me a question about power, and my knowledge isn't as much like it used to be on that. Okay, it was probably from the last group. But if you were to acquire, let's say, a power company, the way a power company operates is a power company owns like a fleet of power plants in all different regions, and power companies basically buy and sell power plants and kind of hedge against them like assets in the portfolio. You want some in the summer month, you want some in Florida that you know will be operating all the time. If you have some power plants up here, you know, think about heating in the summer days and things like that. Some plants might not operate at 100% capacity, and there's a strategy behind that. So when a power plant company acquires another power plant company, you have to consider, what am I interested in? Am I interested in acquiring the entire business, including its intangibles, or just the assets of the business? And there are benefits and drawbacks to looking at it either way. So for example, if it's a power company, you might be just interested in the assets. And if you're just interested in the assets, then a simple way to do it, to acquire it, is to value each asset, add it all up, and when you acquire it, you'd raise the debt or equity accordingly to match the funding, and it'll just increase your PP&E. That's it. However, if I'd like to take a look at, like, let's say, a consulting company, where just the assets of the business isn't necessarily everything about the company. There's the intangibles, there's the clients, there's the people, there's the relationships. Things that just adding up the PP&E won't give you or won't get you. And this is a very loose and crude example, but just to give you an idea. In that case, you'd probably want to consider an acquisition of equity. Okay. However, when you're acquiring just the equity or the entire equity of the business, because the way you're adding it in, you're adding in the PP&E, you're adding in the AR, you're adding in the AP, you're adding in potentially some liabilities or maybe eliminating some liabilities. The price that you've paid for the equity, if it's greater than what its assets value is or what its book value is, that gets recorded as goodwill or some form of goodwill. You can't just say, okay, I'm going to pay $20 million for a company that's book value is $10 million. Where does that get accounted for? Where does that additional $10 million go? When this has been, we'll talk a little bit more about goodwill, but this, okay, maybe you could say, well, a little bit was increases PP. We can't just put PP&E at $20 million. You can't do that when you acquire a big company. So it goes in as goodwill. This is this accounting kind of unknown for the differential between what you've paid and what the sum of all the assets are worth. The sum of all the assets and the liability, that's book value, the shareholder's equity. Now, goodwill cannot get depreciated. So companies try to avoid this goodwill because you want tax deductions. You really can't get tax deductions. You can write down goodwill later, but there are rules around that. So, what are benefits of acquisitions of assets versus acquisitions of equity? What do you think about the benefit of doing that?
Depreciation.
You get the added benefit. If I could treat this roll-up of power plants as an acquisition of assets, I paid $20 million for 10 million power plants, it's PPD $20 million. That's it, no questions. There's some questions, but you depreciate that whole thing. If I had treated it as an acquisition of equity, that difference has to be goodwill, and you can't depreciate that. That's a negative. Okay, now, why can't you just treat every asset as an acquisition of assets? Well, you have to file for it, you have to be elected for it, and usually the seller won't allow that to happen or doesn't want that to happen. Because basically, if you're acquiring just the assets, the seller is left with a shell company, an empty shell company, and they are taxed twice. Because if you're a seller and you're left with a shell company, right? So people pick out the assets, they give you money for the assets. You still have the corporation. So you'll have an income statement with the sale of assets. You get a capital gains tax. And then as the seller, then you say, okay, well, I want to liquidate this company, and I'm going to take the money out as a distribution. Your tax is distributions. You're taxed twice. If you were to sell the whole company, it all goes and you're just taxed one time. So the seller does not want that double taxation.
The seller wants to get rid of the whole shell company.
So the seller always wants sale of equity. The buyer always wants purchasing assets. That's always the fight.
So when you say sale of equity, you mean sale of the whole company?
Whole company.
So including the debt?
Everything. Well, you can negotiate debts, and we'll talk about that, but just generally.
A question.
Yeah.
Can an acquirer get the whole shell company, which is the whole equity, and still depreciate all the assets that come with it, right? Or does he have to treat all of that as one entity and a goodwill, and then he can't really do anything about that?
You could pick it apart, and we'll get into that. You can pick apart. This is called purchase price allocation, and we're going to get into that because a lot of you guys have been coming back to me and been getting grilled on purchase price allocation if you say you know M&A. So we'll get into that. Yeah, it's not as clean cut as all goodwill or all assets. When you are acquiring the equity of a business, and I said the purchase price becomes goodwill, you can kind of pick it apart and get appraisers and say, well, some of this is for assets and some of this is intangible assets, but you're still going to always have a little bit of goodwill left over. So yeah, it's not as bad as it sounds, but usually you never get all of that as assets. But there is a best of both worlds scenario where you can buy the entire business and you can treat it as an acquisition of assets, meaning you step up everything, to your point, and the seller can sell everything and get the one-time tax, and that's called a 338H10 election. Write it down, memorize it, because I'm going to ask you about it on the test. Say 338H10 election. 338H10 election.
338.
Yeah. It'll make you look smart if you say you know it. 338H10 election. To the buyer, they get to step up the assets on the acquisition, and the seller, they get to sell the entire entity. It's the best of both worlds. Just know that 338H10 election. So if you are in an acquisition scenario, you would usually go through a filing process to garner approval to file for this 338 shared election. And approvals, generally these rules change on who gets approved, but usually it's only allowable for S corporations, not C corporations, or if you're acquiring a subsidiary of a larger corporation. So usually this happens more in private equity than, you know, corporate M&A, unless you're acquiring a subsidiary. But this alleviates the conflict between the buyer and the seller. Was that true?
Or if you acquire a subsidiary?
Yeah, or if you're, or of any corporation. Yeah, I haven't looked up the rules in the past couple of years, but they change quite frequently, but that was the latest. I should look it up again. Maybe the past year.
Particular source, you just Googled it?
Yeah, there's
Oh, yeah,
like a KPMG thing on, you know, on and it's public on who's allowed to. So if anybody asks you 3 ways to account for an acquisition, you can account for it as an acquisition of assets, as an acquisition of equity, or as a 338H10 election. It's a test question, M&A test question. I can repeat that. Acquisition of assets, acquisition of equity, or a 338H10 election, okay? So, if you were to file for an acquisition of assets, you'd get the step up. Okay. You get to, instead of having this purchase price above the value become goodwill, it's all assets. It's all PP&E depreciated all.
Yeah.
If not, you got to pick it apart and it becomes more problematic. From here on out, we're going to do the more complex version where you have to pick it apart with goodwill. Okay? So we're going to start talking about corporate acquisitions. Chapter 4. 5. You're welcome. Do you have any questions? Okay, so let's talk about this. And we're going to talk about, let's assume from here on out we're acquiring equity, forget the acquisition of assets, with the more complex version, goodwill and all this stuff. What happens? We're going to look at acquisitions from a technical perspective in 2 scenarios. A mini merger model, or maybe more formally known as an accretion dilution analysis, which assesses just the high-level impact of the financial benefit of an acquisition. We look at just the impact on earnings per share, as opposed to a full-scale merger model, which is merging 2 whole companies together, whole income statement, cash flow statement, balance sheet, depreciation schedule, working capital schedule, debt schedule. We'll look at that later. The full-scale merger model is the kind of ultimate end goal of the M&A course, and it's basically building 3 models. We're going to do Office Depot, Office Max. It's a full operating model, Office Depot, full operating model, Office Max, and merging it all together. I mean, I'll give you the individual operating models. You won't have to build them, but we'll have to merge them. It's every kind of nook and cranny. But the accretion dilution analysis is great for practical purposes because a lot of times you might look at 4 or 5 different companies and you don't know which one your client will like. And instead of building 4 or 5 full merger models, which would take you forever, you would just do a quick, this is just a 1-page analysis to see even if it's financially viable and even if the company remotely likes it before going forward. And for instructional purposes, it's a great way of stepping back and understanding what the major movements are before getting caught up in the nuances of every single line item of an income statement, cash statement, balance sheet. So we're going to start with this mini merger model. We're going to look at the high-level impacts. We're going to do practice paper analysis. The test will be the paper analysis. This was the second half of the Goldman Sachs case. And then we'll do a 1-page model, accretion dilution model, and then we'll kind of evolve into the full scale. So a mini merger model or an accretion dilution analysis estimates the impact on EPS of acquiring a company. So really answering what impact or effect does a merger have on my PE, EPS, credit, accretion dilution. So the key line items we're going to look at is what's the impact on the bottom line earnings and the shares. And both of those things move. Okay, so in order to assess this, the first thing we look at, I look at a merger. Actually, I'm going to look at every transaction we do. Any transaction you do, you should look at in these 3 major steps. Number 1, figuring out the purchase price of the entity that you're valuing or that you're analyzing. You figure out the purchase price by doing a DCF valuation analysis, right? Figure out the purchase price. Then we have to come out with the total sources and uses of cash. The sources is The uses, the sources is where are we going to come up with the money? Are we going to seek out accessing lenders, equity holders, private equity? And the uses is where is all that money going to go? What are we paying for in total? And then part 3 is the pro forma adjustments after the formation or after the transaction, the analysis. The analysis is part 3. In any transaction, there's always going to be these 3 segments. We got the first, what's the purchase price? How are we going to fund this? How are we going to source it? And then where is it going to go? Okay. So the purchase price, we're going to do, as Drew suggested, we're going to use valuation. And it's important to understand whether the company is public or private, and I'm going to explain to you why. But first, let's look at the sources and uses. When looking at the sources and uses are really, how are we going to fund this? And what's the money for? So how am I going to pay for this? Sources and uses. The uses, I like to start with the uses, where's the money going to go, usually is summarized in 3 major categories. The purchase price. The purchase price represents paying for the equity of the company. We're paying off the equity holders. This is why, if you remember, I think the week before last, we started talking about understanding whether the purchase price is an equity value or an enterprise value. We talked about the precedent transaction, and I'll break into that a little bit more. But the purchase price generally reflects paying off the target shareholders. We're raising money at a premium to ask the shareholders to give us their shares and go away, and then we are the owner. Basically, that's the purchase price. We also have to consider paying the target company's net debts under certain considerations. So we have to think about that. And as an analyst, you have to understand and think about what situations would you have to pay down the debt or choose to. Let's look at that now. Let's look at that now. So when would we know if we're required to pay down the target company's net debts? It depends on a couple things. First of all, it depends on whether the company is public or private. Because if the company is public, the owners are the shareholders. If the company is public, you as the acquirer must consider responsibility for the debt. You can't just take everything but the debt and leave the debt to the shareholders. It's illegal. You can't do that. Shareholders have nothing from their recourse. Right? So you as the acquirer, if the company is public, have to consider what to do with the debt. And you have 2 options. You can either keep the debt on the balance sheet, which means it goes along with you as the acquirer, you just kind of roll it up, or you raise additional funds to pay that down. So you can either choose to do that, or you could be forced to do that. And the first thing you would do as an analyst, if you can, is look at the covenants. You guys know about covenants, debt covenants? Every debt that's raised will come with a set of covenants or laws to manage the debt. You have to pay a 6% coupon payment on the 31st day of every month.
Kind of like what covenant for lower, right? Like you get
exactly.
All of those.
Exactly. All the terms. It's all the terms. And they sometimes have a bankruptcy or change in control provision. Sometimes, meaning if this company is going through a major company event, bankruptcy, change in control, we want out. We want to get paid back. This wasn't what we signed up for, basically. So you have to look for that. If those provisions are in there, then you as the acquirer have to be prepared to pay down that debt. You have to raise additional funds to pay down that debt if those covenants are there. So if the company is public, look at the covenants. If those covenants are there, you know you have to raise additional funds to pay down the debt. It becomes uses. You're paying down the equity and you're paying down the debt. If those covenants aren't there, you have a choice. You could still choose to pay it down. You choose to pay it down if you think you can get a better rate, if you want to refinance. Or sometimes it's better to say, you know what, I like those debts. I'll just keep them with the company and roll them up.
But then if the covenants say that you can't do that,
then you have to do it. Yeah.
Then you have to either
Yeah.
source extra fund
Yeah.
or you raise that.
You have to. Yeah, you have to source it somehow.
I'm sorry, because if the debt has to be paid down, then is it a problem of the target because it's like this debt, so it has to be paid before it gets acquired?
You can't if the company is public, because then you're leaving the debt with the shareholders. So you as the acquirer have to decide, well, I'm going to wait until the company pays down its own debt. But you can't buy the company and leave an empty shell company with debt. There actually are Unless there's somebody else there to take over the debt. I mean, there's other ways you could do that. There's somebody else has to go take responsibility for that debt, though. So where the debt goes is a consideration. Now, if the company's private, it's a little bit different, because if the company's private, you can basically do what Beatrice was suggesting. If the company's private, you can kind of say, okay, I'm just going to take everything and leave the seller with the shell company, leave the seller with the debt. And the seller, you take the money that we gave you and you pay down the debt and you deal with all that. You could do that if the company's private. There, it depends on negotiations.
Wouldn't that still be looked at the same way that the shareholders of the private company?
Sure, the shareholder is probably like a family, right?
They could very well say they don't want to, right?
They could. Then it becomes up for negotiation. But what I'm trying to say really behind, and this is more for LBO, so I'm jumping ahead a little bit. What I'm trying to say in the private scenario is a lot of times you guys in an LBO will value a company as a multiple of EBITDA, right? In LBO, it's usually always valued as a multiple of EBITDA. If you're valuing a company, Ray agrees with that. If you're valuing the company as a multiple of EBITDA, then the purchase price is an enterprise value, right? If it's an enterprise value, then that effectively, the purchase price effectively includes the value of the debt. So if you're negotiating a purchase price with the seller and you say, I'm paying 7 times EBITDA, and you give the seller that money, you're basically telling the seller, I've already paid you for the debt. Don't give me the debt. Because a lot of times I see a lot of analysts put purchase price and then include net debt, and if the purchase price was an enterprise value, you're double counting the debt. I've seen that happen in real situations. They double count the debt. I don't know if that's what happened. We didn't talk about that. It was not clear, and I went through a lot of filings to see exactly where they were wrong. I don't think they double counted that way. I honestly think somebody's putting together comps, and I just accidentally, the formula is enterprise value plus net debt. I think just some analysts just put a minus instead of plus in there. I think it was just like a bust in the formula. Yeah. I honestly think because that logic didn't make sense. I thought through that logic, but it didn't make sense because they said that the value was understated, and this would have done the opposite. It does done, yeah. So I'm thinking about the same. Yeah, and I'll be honest with you guys, I've seen that happen a lot. I might have even made that, where you're just kind of in the comps and you're just accidentally putting a plus because you're thinking about it backwards. It's just easy to think of equity value minus debt or plus debt. I think that's kind of what happened. I've seen so many mistakes like that. You're supposed to add back debt. And they must have just accidentally threw a minus sign in there. Something like that. That's my guess. When I did the math, but it wasn't clear. And I thought it'd be in the filing, like exactly what went wrong. It wasn't. They just said it was overstated, and this is what it should be, and that was it. And the valuation was readjusted, and that also looked like it went the opposite way. It went the opposite way. Yeah. So it must have been a minus instead of a plus, and then why would you do that? Just analysts, associate overlooked it, and then nobody thought to look at it. Happens a lot. But never really leads to such public circumstances. It probably gets caught earlier. Yeah, it probably gets caught earlier. So the uses, the purchase price, considering the target net debt, and then transaction fees. You got to think about fees, banker fees, legal fees, due diligence fees. All these fees have to get added up. You have to pay for all of it as an acquirer. You got to pay for all this, the purchase price, potentially the target net debt, and the transaction fees. So the total uses of cash is a sum of everything. If you have to pay down, so it's the purchase price, if you have to pay down the target net debt, you have to add it to the uses. If you don't have to pay down the target net debt, it's a zero. You don't add it. It just sits on the balance sheet and it gets rolled up later. And then the transaction fees. And the sources are where is the money coming from. So where's the money coming from is some combination of debt and equity. Or maybe excess cash if you have cash on hand. So if you're raising equity, you're raising equity to pay for the uses. If you're raising debt, you're raising debt to pay for the uses. Or some combination of the two. And it's important to understand, like we talked about yesterday, the EPS impact of the equity and the debt. Right? We talked about raising more equity, probably a harder hit, probably, not always. We'll look at situations where it's not always, probably a harder hit on EPS. Raising debt, softer hit, but it impacts your credit. So that's why, that's sources and uses, and that's why I mentioned the purchase price and whether you have to pay down the debt is dependent on whether the company is public or private. Right? If the company is public, Whether you have to pay down the target net debt or not depends on the covenants. If the covenants of the debt say there's a change in control issue, we're done. We don't want to get paid back, then you have to add the target net debt to your purchase price. Which means you have to find a way to pay that down. If the covenants say you do not have to, then it's your choice. And you might say, well, I still want to pay it down anyway because I can refinance, I can raise my debt as a source and get a better rate, then great. Or if you say, you know what, no, I don't want to deal with it, I don't want to raise additional funds, then the target net debt is 0. And later on in the merger process, that debt stays on, it gets rolled up into your debt, and you're taking on their debt. If the company is private, it depends on how you valued the business. If you value the business based on a multiple of EBITDA, you're basically saying, that purchase price that I found out with my valuation based on EBITDA is a purchase price of the equity and the debt. So I'm not going to add debt to that purchase price because I'd be double counting debt because my purchase price already includes the value of debt. You can separate that out or make it clear some other way. But if my multiple that I used to purchase was like a PE multiple, that's an equity value, then I still have to consider the debt. And so the total uses of cash are those 3 categories. The purchase price, considering the target debt, considering transaction fees, and the sources, how am I going to fund it, is a combination of debt and equity.
Into that part one more time, if you're valuing PE multiple.
PE multiple, then the purchase price is based on an equity value, so you have to consider the debt separately. It's not already included in the value. Okay. This is a good stopping point. So now we're going to start to get into, I'll give some examples. They're in the workbook, if anyone's gotten the workbook, about kind of just getting familiar with reading about transactions in different ways and what does this mean for purchase price sources and uses. We'll start to get into that, and then we'll further this with the actual accretion dilution analysis. Okay? Good?